Hi everybody! Financial market failure occurs when freely functioning financial markets fail to allocate financial products at the socially optimum level of output. The end result is a misallocation of resources in financial markets. The next video looks at 4 specific types of financial market failure, but it's worth in this introductory video grouping up generically the reasons behind financial market failure. And then once you watch the next video, you can apply those very specific causes to these section areas. The first section area occurs when there is excessive risk being taken. And because there is excessive risk, there is a greater chance of bank failure and then systemic risk, i.e. Financial collapse and the whole financial system coming down. So if excessive risk is being taken, assets are being created and then bought and sold which are ridiculously risky, there is a greater chance of those assets going bad. And then it's not just the individual firm that goes bust, it can lead to an overall collapse of the financial system. So basically there is an overproduction and an overconsumption of these excessively risky financial assets. The key word is excessive risk. The consequences of this is that systemic risk is so much more likely. Now remember what systemic risk is. This is when there is bank failure, which is more likely to happen if there is excessive risk being taken here. But one bank failing can lead to many other banks failing, which can then bring down the entire financial system. I've covered that in lots of detail in previous videos. But the end result is that if the financial system goes to pot, there is a loss of confidence in the banking industry, in the financial industry, there is a loss of faith in banks. All bad news when banks are the backbone of the economy. Banks and the financial industry is why the UK economy is so big and so great. It's why we are the 5th largest economy in the world. We're very, very rich because we have a very strong financial industry at the backbone of our economy. Imagine if the faith and trust in banks is totally gone and confidence in the industry is completely gone. The impact it's going to have on the economy is significant, right? So systemic risk is a nightmare, and that becomes greater if excessive risk is being taken with the production of financial products and financial assets. If the financial system goes bad, if there is a complete collapse, we get financial crisis, we get deep recession like we saw in 2008, 2009. And the end result of that is not just lost incomes, lost jobs and lost output in the financial industry, but it's lost incomes, lost jobs and lost output throughout the entire economy. Deep recession, horrible consequences. We also might see bank bailouts like we saw post the deep financial crisis of 2008. And bank bailouts impact on the taxpayer. There is a negative externality there, where the taxpayer has to bear the cost of these bailouts. And we are still suffering, the taxpayer, from bailing out all of these banks from the 2008 financial crisis. So the end result of excessive risk and then an overall collapse of the financial industry is very, very, very significant on society. The other group that we need to consider here for financial market failure is when there's collusive activity. So maybe financial market agents get together, or maybe banks get together and they collude to fix interest rates or to fix exchange rates in whichever way benefits them. Basically, we see monopoly pricing and we see a loss of welfare in these financial markets, which is a market failure in itself. Not good news here, where these agents and these firms get together simply to maximize their profits against the interests of society. What's also really interesting to know, guys, is that some say that deregulation of financial markets in the 1980s, 1970s and 1960s in both the UK and the US actually exacerbated financial market failure. It increased systemic risk. This deregulation was known as the Big Bang. It really made financial markets take off, and the financial industry in both the UK and the US explode into massive proportion, where now it is the backbone of both the UK and the US economy. Huge, huge industries now. And it happened because this deregulation happened because Thatcher and Prime Ministers before in the UK, for example, wanted the economy to move away from manufacturing and mining towards financial services, towards the financial industry, allowing the UK to become much bigger. But some say it increased financial market failure, exacerbating it crazily, and increased systemic risk. Why? What kind of deregulations occurred? Well, look at how significant some of these were. Taking away, for example, capital and liquidity ratios. Now, that doesn't mean totally taken away. It means central regulation was taken away. So governments, for example, setting those ratios was taken away. And this was left now to the commercial bank, for example, to set capital ratios, to set liquidity ratios for themselves. Also scrapping reserve requirements, right? That again was centrally controlled in the UK in the 1960s. taken away with deregulation in that period of time. Very, very significant because it meant that the chance of bank failure is so much greater. What also happened, well, this major deregulation took place where commercial banking and investment banking no longer had to be legally separate entities. With deregulation in the 1980s, commercial banks and investment banks could work under one branch. So for example, Barclays have got a commercial banking side, a retail banking side, and also an investment banking side. Separate parts of their business, but still under the Barclays brand. That's allowed to take place with this deregulation now, for example. And that's dangerous because it means that commercial banking funds, safe profits that are made on the commercial banking side, could be used for investment banking activities which are much more speculative, much more risky, much more likely to fail. The reason why they want to do it is because you've got safe funds here, which you're always going to have, to maybe make loads more money out of. Gambling in the investment banking side, for example. The danger is, though, that investment banking activity is so much more risky. The chance for those activities to go bad is much greater. And then it's not just the investment banking side of the business that will go down. It's the commercial banking side of the business that can go down too. So the risk of general bank failure is so much higher with these deregulations. What also happened with deregulation is that excessive bureaucracy and paperwork and red tape was taken away. And that's all well and good. That just improves the efficiency and the competition of financial markets. But these three deregulations improved, some say, the risk of financial market activity and increased the likelihood of bank failure and then systemic risk of the entire financial system going down. So interesting to know where potentially the increased chance of market failure came from. Some say this was the case, some say no, actually it wasn't this, but worth taking this away. Maybe this is the root cause of why there is such a greater chance of financial market failure and systemic risk like we saw in 2008. Stay tuned for the next video where we look at 4 specific types of financial market failure. I'll see you then. Thank you very much for watching, guys.